Welcome, everyone, to today's episode of Secure Finance Insights. I'm your host, Alex, and with me is Jordan, an experienced trader and financial educator who's helped countless investors navigate the complex world of Forex. Jordan, it's great to have you here.
Thanks, Alex. It's really exciting to be here and unpack some of the misconceptions about brokers and trading safety.
Absolutely. So today we're diving into a topic that can literally make or break someone's trading journey. Brokers, the people or platforms that act as the gatekeepers to the Forex market. Jordan, why does this matter so much?
Well, Alex, think about it this way. Forex is like a vast flowing highway of money where currencies are constantly moving. The broker is the toll operator or bridge across that highway. If that bridge is well built and trustworthy, you get across safely. If not, well, you could be in for a very costly fall.
Right. And I think a lot of people underestimate that. It's not the market itself that's inherently dangerous. It's choosing the wrong intermediary.
Exactly. There are horror stories of platforms that disappear, withdrawals that never happen, or advisors who take your funds under the guise of helping. This is why understanding regulation, execution models, and trust is crucial.
So why now? Why should listeners care about this today?
Forex is huge. It's the largest and most liquid market in the world, moving trillions daily. But along with opportunity comes risk. Lack of regulation can leave investors exposed to fraud, lost funds, or manipulated trades. With more people trading online than ever before, knowing how to pick the right broker is no longer optional. It's survival.
And that's where the distinction comes in. The broker can either be your ally or your counterparty. Let's break this down. There are two main types of brokers, right? Market makers and ECN or STP brokers.
Right. Market makers are like parallel service roads. They, quote unquote, make the market themselves. They set bid and ask prices internally. The problem? They act as your counterparty. If you win, they potentially lose.
So a conflict of interest exists by default.
Exactly. That's why strict regulation is crucial here. A reputable market maker will be fully regulated, minimizing the temptation to manipulate prices or executions.
And ECN STP brokers?
They're the pure connectors. They route your trades directly to liquidity providers like big banks. Conflict of interest is minimal because the broker makes money from commissions rather than your losses. They actually benefit from you being a long-term successful trader.
That's fascinating. So one model incentivizes your success, the other not necessarily.
Yes, which is why due diligence is essential. Ask about execution models, fund segregation, and regulatory licenses. A good broker will provide clear answers.
Regulation, the seatbelt for your capital. So speaking of licenses, let's talk regulation. Some people think all regulations are the same, but that's not true, right?
Not at all. There are Tier 1 regulators, the gold standard, like the FCA in the UK, ASIC in Australia, NFA or CFTC in the US, and CISEC in Europe. These regulators enforce rules that protect investors, like segregating client funds and limiting leverage.
Segregation of funds. That's a life or death safeguard, isn't it?
Exactly. Imagine the broker goes bankrupt. If your funds are segregated, they remain untouched in a separate account. If not, well, your money could disappear with the broker's creditors.
That's a scary thought, and yet many still trade with offshore brokers with weak oversight.
Yes, often chasing higher leverage or bonus schemes, but those are the floating casinos of finance. No recourse if something goes wrong.
Let's shift gears. Beyond mechanics, what about the psychological side? Fear, greed, impatience. How do these play into broker selection?
Big time. Investors who chase quick profits or promise themselves guaranteed returns are often blinded to red flags. That emotional bias can lead them straight to unregulated brokers. Discipline and reflection are key. You have to separate emotion from decision-making.
So, in a way, choosing the right broker is as much about mindset as knowledge.
Absolutely. Emotional discipline protects not just your capital, but your ability to think clearly in fast-moving markets.
Practical application. 5 steps for due diligence. Let's give listeners some concrete steps. How should they audit a broker?
Sure, here's a 5-step approach. Verify the license. Go to the regulator's official website, check the license number, confirm the entity's name and address. Logos on a website aren't enough. Evaluate leverage. High leverage can be dangerous. Stick to what your strategy requires, ideally under Tier 1 limits. Check negative balance protection. Make sure you can't lose more than you deposit. Review spread history. Ensure the broker doesn't manipulate spreads during news events. Transparency is key. Confirm compensation schemes. If a Tier 1 broker goes bankrupt, you should have protection via FCSS or ICSS.
That's a solid checklist. It feels like life insurance for your trading journey.
That's exactly how I frame it with clients. Your money is sacred. Security always trumps potential quick gains.
And I think that's a lesson that applies to more than just Forex, right? It's a mindset for all financial decisions.
Exactly. Treat your capital like a marathon, not a sprint. Security first, growth second.
Thornton, this has been incredible. I feel like listeners now have a practical, emotional, and strategic framework for navigating brokers safely.
Thanks, Alex. It's been a pleasure. Remember, due diligence is your best weapon. Always.
Absolutely. And for our listeners, start today. Audit your broker, educate yourself, and protect your capital. Until next time, stay informed and trade wisely.
Take care, everyone.